Hello, chasers! Today's episode is about the costly mistake that landlords often make when they claim the work done on their properties. I'm your host, Chris Becks, a financial and business advisor with over 40 years' experience and the founder of the multi-award winning CBEX Business Solutions for Good. And as this is an accounting and tax topic, as a member of CPA Australia and registered tax agent, I'm obliged to give you this general advice disclaimer before we begin.
The advice provided is general advice only, as in preparing it, we did not take into account your investment objectives, financial situation, or particular needs. Before making an investment decision on the basis of this advice, you should consider how appropriate the advice is to your particular investment needs and objectives. You should also consider the tax implications on your financial situation. Chris Becks, CPA member number 805103 and registered tax agent number 629433015, is a director of CBEX Business Solutions for Good and is authorized to provide accounting and tax advice.
Now that is done, let's dive into this episode. Landlords always want to maximise their rental property tax deductions and want to claim work done on their properties as a repair because that means a 100% immediate tax deduction. A common mistake that landlords make is incorrectly identifying the type of expense incurred when claiming expenses for work done on their rental properties. It's important to understand the difference between repairs and maintenance to the rental property and capital improvements. As a landlord, you're entitled to claim deductions for expenses incurred in the course of earning rental income. This includes the cost of repairs and maintenance to your rental property. However, many landlords mistakenly claim capital improvements as repairs, resulting in an incorrect tax deduction. So, what is the difference between repairs and capital improvements? Repairs are work done to fix or maintain something that is already there, while capital improvements are work done to restore the asset to the condition it was in when a landlord started to rent out the property or extend the life of an asset. Let's take an example. Say a landlord arranges for a plumber to replace a broken element in a hot water system in their rental property. This would be classified as a repair because it is replacing something that was already there and is necessary for the property to continue functioning as it should. The Australian Tax Office provides some guidance here. They advise that ongoing repairs that relate directly to wear and tear or other damage that happened as a result of you renting out the property can be claimed in full in the same year you incurred the expense. A common mistake for newbie landlords is claiming the cost of initial repairs soon after they have acquired the investment property, or even before it has begun producing rental income. They think that if they buy an investment property, get the keys and decide it needs an internal paint job before they get a tenant, they should be able to claim that paint job as a repair. Initial repairs for damage that existed when the property was purchased, such as replacing broken light fittings and repairing damaged floorboards or painting, are not immediately deductible, but a deduction may be claimed over a number of years as a capital works deduction. These costs are used to work out your capital gain or capital loss when you sell the property too. If our landlord decided to install a new hot water service to the property, this would be classified as a capital improvement because it adds value to the property and extends its life. Similarly, replacing an entire structure like a roof or boundary fence when only part of it is damaged or renovating a bathroom or kitchen is classified as an improvement and not immediately deductible. If you completely replace a damaged item that is detachable from the house and it costs more than $300, for example, replacing the entire hot water system, the cost must be depreciated over a number of years. It's important to note that capital improvements cannot be claimed as an immediate tax deduction. Instead, they are added to the cost base of the property and can be claimed as a capital gains tax deduction when the property is sold. Capital improvements are building costs which you can claim at 2.5% each year for 40 years from the date of completion. You can claim certain building costs, including extensions, alterations, and structural improvements as capital works deductions. Where your property was owned by someone else previously and they claimed capital works deductions, ask them to provide you with the details so you can correctly calculate the deduction you're entitled to claim that is left. If you can't obtain these details from the previous owner, you can use the services of a qualified professional who can estimate previous construction costs and prepare a specialised depreciation report. A word of warning: accountants, lawyers and real estate agents cannot do this as they don't hold the relevant building qualifications to prepare this type of report. A quantity surveyor who is university trained and approved by the ATO are the most qualified professionals to produce these tax depreciation schedules for investment properties. A quantity surveyor provides advice on all aspects of construction costs, from estimating and tendering to contract administration and project management. So why is it important to distinguish between repairs and capital improvements? Well, the ATO is under clear instructions to review the expenses of taxpayers who have rental properties. And if you claim a capital improvement as a repair, you could end up paying more tax, plus penalties for incorrect lodgement, than you need to. This is because capital improvements are not immediately deductible, so you would need to claim them over a number of years. In summary, as a landlord, it's important to understand, number one, what qualifies as a repair and maintenance, especially initial repairs soon after the purchase of an investment property or before the property is rented. Number two, what qualifies as capital improvements when claiming deductions for work done on your rental property. And number three, who can prepare the specialised tax depreciation schedules, especially not your accountant. By correctly classifying your expenses, you can ensure that you are claiming the correct amount of tax deductions and avoid any potential penalties from the Australian Tax Office. Thank you for listening. I'm Chris Becks, and I look forward to presenting our next episode to you.
If you enjoyed this episode and you'd like to help support the Chasers channel, we would love you to share it with your business friends and colleagues, post about it on social media, or leave a rating and review. To catch all the latest from CBEX Business Solutions for Good, follow us on Facebook at facebook.com/CBEX, Instagram at CBEX, and on the internet at cbex.com. Thanks again, and we'll be sharing new info with you on our next episode.